You are listening to Mining Stock Education, where you'll learn from the top leaders in the natural resource sector and uncover quality mining investment opportunities.
I'm Bill Powers. It's Mining Stock Education. Thank you for tuning in. We're speaking today to Joe Mazumdar of Exploration Insights. Joe, welcome back onto the program. And there's a lot of geopolitical issues going on that's causing the price of gold to go up significantly in the last few weeks. When it comes to how war affects the resource investor, could you share some insights with us? How have you managed a junior resource portfolio through the threat and effects of war?
Well, I mean, you've got getting over the human, aspects of this and all the other, politics related to it. If we're just talking about resource sector, I mean, the recent geopolitical crisis and the ongoing stuff, I mean, right now, the Ukraine stuff is not really impacting the market. It might be impacting some commodities, like grain and stuff like that in terms of logistics. But right now, overall market, I don't think it's impacting it very much. What is impacting it now is more what's happening in the Middle East and the potential for that to impact oil even more. And that would impact costs, and that would impact producers towards the second half and potentially into next year, depending on how long this goes. If there is an oil embargo or something else happens. So that's one aspect of it. And then does that send the global economy, which is also a bit teetering now with weakness in China, does that send that growth slower? So then that impacts all industrial metals, in near term, like copper and nickel and iron ore, what have you. And then on the other side, on precious metals, all the geopolitical risk. And then does this spill over into Taiwan and China? Who knows? That supports safe haven assets, which gold is one. Usually the impacts are ephemeral. They don't last very long. But this crisis is just beginning, and nobody's really sure how it's going to end. And so that has that underlying support for gold, which, is helping, some resource stocks. But I think the worry about cost escalation versus, oil, the higher interest rates, where do we go with that? Has more people on the fence with respect to equities. And that's just not resource equities. That's almost all equities. And so, it's almost better to look at physical gold right now than going into equities. And we could talk about that when we delve into financing. But yeah, right now, it's hard to know. It's hard to predict. Because going into the year, I'm, continued to be very bullish on copper, but the near-term aspects of what was happening in China definitely put a damper on that. I don't think the medium-term changes at all. If not, it looks even better. But, it's hard to predict, a crisis in the Middle East. It's hard to predict, the Russian invasion of Ukraine, or potentially what might happen in Taiwan. And those things are not things that any geopolitical observer, would have said, oh, that's going to happen, this year. And me, less likely.
Have you ever done any studies, and this is just a question off the top of my head, like on tungsten as it relates to the war cycle? So if you get these minerals that are used for plating tanks or in munitions, like how does that commodity price cycle through a war? Have you studied any of that in the past?
No, but I know that, especially with the Department of Energy, Defense, I mean, they hold stockpiles of certain metals that they deem to be strategic, critical for them. And that doesn't go out to everybody to know, but I'm sure they do that. And they're whether you see the Department of Defense or Energy allocating capital now to critical or strategic minerals, that's part of the concern as well, is the higher, level of technology in some of these weapon systems that require some kind of minerals or metals that might have, mostly be processed in places like China, whether it's rare earths or other elements.
Joe, if a resource investor is not positioned in lithium juniors right now, as lithium has been hot for a while now, would you recommend taking a look at lithium stocks, or what's your analysis of the sector overall right now?
So lithium, the lithium carbon equivalent, which is not free trading that much, but it's still out there. It's not very liquid. It's down about 65 to 70% year to date. After hitting new highs, all-time highs last year. But the lithium equity ETF, LIT, is down only 15 to 16%. And what's underlying that is industry consolidation, because we see the Alchems and Livents merging. We're seeing single asset explorers and developers being acquired or being funded, whether it's Patriot Battery Metals with Albemarle, with a big financing, Liontown being bid up, and also there's another one in Australia that just got bid by Sokovich, by SQM. So all that consolidation makes people think, wow, that's the sector I want to be in, and hence the lithium equities have done quite well. Because we're in a moment where lithium is needed, but the optimal way of getting lithium, which might be from the brines or from direct lithium extraction, technically one isn't commercial yet, the DLE technology, and the other one has a limit in terms of how many brines there are out there. And that's why something like Thacker Pass, which probably never would have been built anywhere else and requires about $2.2 billion, is getting funded $650 million by Ford and $1 billion by the Department of Energy, I believe, in their biggest potential allocation of capital to what they'll call a strategic mineral over critical, because what is critical, they've got their list, but what's strategic is really lithium for them and rare earths. Those are two very strategic minerals for them. So yes, I would say a lot of them have run up, but the industry consolidation and also the government's putting money into it suggests that the financing risk for a lot of these lithium projects is much less than other sectors right now in the commodities.
Snowline Gold is one of the success stories in the gold exploration sector. I believe they had about a $700 million market cap last time I looked. When a market cap of an explorer gets that big, Joe, is it just hands off just because of the size? You missed the run up from 20 cents to $5. Do you stand back, or would you take a serious look at a play like this?
Well, I had an opportunity. I did visit it last year, and I was impressed by the management. And technically what they're doing. So that's probably why they get such a premium, because of the quality of the management. Their ability to attract a potential suitor in B2 Gold, in terms of helping them fund. So that they've got more than enough money. Well, I'll take that back, because, for them, in terms of drilling, that could be $800 to $1,000 per meter up there. Remote, helicopter supported, diesel generated, that sort of thing. So my issue was more infrastructure. Infrastructure is less of an issue for a gold project than it is for a base metal project, but it is remote. So some of this grade that they get, which is great for an open pit, metallurgy is fantastic, I believe, because I went and saw the core. A lot of it was very coarse and visible. And I think now they have a better understanding of the geological constraints on the high grade. But still, infrastructure is a problem in the Yukon. If this was in Ontario or Quebec, this would get built in a second, and it might even be worth twice as much as it is now. But infrastructure will be a problem, and the money that they need, they will spend, because it won't be cheap to drill there. My next trip, I just came back from Chile and Peru last 2 weeks, and my next trip is to Yukon Geoscience. So that will be about critical minerals, because they are interested in that. But the Yukon's problem is, as they don't have a big enough population base to invest in the infrastructure required to build a lot of these projects.
So what are you most bullish on, Joe, when you look over the commodity sector? I look for the macro trends before I go down into the fundamentals of a given company. What do you see? What are you bullish on?
I continue to be bullish on copper because I don't think there's enough out there, and I think right now with all the negativity on industrial metals and the low price of copper, which is not an incentive to develop or sometimes even expand projects, makes that medium-term issue on the supply side, it makes it even more explosive. And so looking at those projects, I don't like mentioning companies, but one of my top picks is Arizona Sonora Copper. And why is it a top pick? It is copper, but it's going to go into that 2026, 2027 development issue where there's not going to be enough. But it is in the U.S., it's on private land, it has access to water, and it's actually going to produce cathode, not concentrate. Because if you produce concentrate in the States, it can't get smelted in the States. It's got to go to Asia. So you don't know what you're going to get back. It's not going to be cathode. It's going to be a car or it's going to be a washing machine. So, if the U.S. is keen on manufacturing and building these things in the U.S., what they're not keen on is developing projects that would feed into that manufacturing. And so if I'm going into the U.S. knowing that this is what they need, I've got to really refine the project, whether it's a project that can be built.
If it wasn't on private land, would you have invested in the company?
No.
Yeah.
There's just too much risk in terms of how this an NGO flies in right before it gets permitted or right after it gets permitted and threatens to sue the Corps of Engineers or another, the Department of Interior. They get all scared and they let it go and suspend it. So I have no, optimism or regard for the government institutions to support their 50,000 pages of documentations and their 5 years of public meetings and all the other, hoops that they make companies go through and then totally disregard them after. So as long as it's state-run, fine. But as you can see, when they really, really need it, like the lithium project at Thacker Pass in Nevada, they did have indigenous groups that were against it. They had ranchers that were worried about the water. But they got their permit. Because why? It's because they really need the lithium. And once they really need the copper, maybe some of these projects will be looked at again. But in the interim, I'm not, sort of like wasting my time on a big development project that's copper, that may never get permit in the interim.
You just lifted up so many risks there that we have to manage as resource investors. What do you see as the biggest risk in Q4 of this year?
Well, depending what you're investing in. The price risk for industrial metals continues, and the big risk there is for a slowdown in global economy. What that sets up for me on the copper sector, even a better market for the ones I think that work, that you can keep advancing. You're not just waiting for that to change in 3 years. You're actually going through, with the production coming into that window, as opposed to now, okay, I'll get funded, and then I come in 3 to 5 years from now. I think that sets that opportunity up better. The other one with gold and precious metals is more so do the interest rate hikes keep going up. If they do, then interest rates go up, and then gold starts moderating. But how long can the I know this sounds bad, but how long can the geopolitical risks that are, embedded right now, how long do they stay and underpin the gold price? Because between central banks and this geopolitical risk, that's what's supporting gold. Because because now we have, people looking at gold equity ETFs, and that'll spill into the equities if this continues long enough. But the problem on the other side is that if oil keeps going up, then a lot more of these margins will get squeezed because still diesel's a significant part of the cost profile. And then on the other side, The other problem is that we have with labor costs going up, especially in the States and places like that. With the new unions and stuff like that, and the bargain being, those costs are going up maybe 15 to 20%. So that's another issue that we might have to deal with.
Joe, what do you think about financing an ExploreCo at these levels? They're at like multi-year levels, and they do a keep the lights on raise, to where they even are truthful and tell you, hey, this raise is functionally for G&A. We're not going to put any drills in the ground because we can't right now. Have you ever supported a company in such a raise?
I guess it depends on the underlying asset. If they can't get money for whatever reason, and you still like the asset and you want them to hold the option, and you don't want them to do anything because you don't want them to have to raise again, and maybe you think that fuse might be 18 months to 2 years and they have enough money, maybe. But that's not something I go out of my way to invest in. But if I'm already in it and I still think it's undervalued, then I have less issues with it. Like I know Liberty Gold did that financing, but their financing was underpinned by a royalty company. I believe it was sure it was a Cisco or but that basically gave the royalty company access to that 0.5% NSR, but it allowed Liberty the option of taking that NSR out and having it. But also it gave them $5 million in their till to keep progressing on the permitting and their technical reports. If gold turns, here's potentially a 3 million ounce deposit going to 5 in a jurisdiction, southern Utah. They have access to water. There are no trees there, like in most of southern Idaho, that they have to deal with. So this looks like a permittable project that can get built, and it's run of mine heap leach as opposed to crushing, so that's lower cost. So those sort of things, specific projects, specific management, I can see, but not a potpourri of things that I would say this is my new sort of investing philosophy or anything like that.
I'd like to get your thoughts on cobalt and investing in cobalt projects. I read something recently to where cobalt as a byproduct of, I believe, copper and nickel mines is going to provide enough supply to meet the year-over-year demand of, I believe, 14%. What do you think about cobalt?
So cobalt 2023, the whole production was about 155,000 tons metric. 60 to 65% of that is from the DRC and from copper projects. And that's just five. So heavily concentrated. And so I tend to avoid metals that are byproduct driven, because the production, the supply is not driven by the price of that commodity. It's usually driven by the price of the other commodity, whether it's copper or nickel.
So would you avoid silver, if I could interject, because of that reason, because so much of it is a byproduct?
Yes. I mean, silver is problematic, but I mean, it gets this huge premium if you get a project that's just silver, because they're rare, but they're usually not very good. So usually the silver comes from byproducts. Another one, the zinc mine, I think it's in Europe, produces, heaps of silver. Bingham produces lots of gold. These guys can produce a lot and they don't even care about it. And moly was another one. So when I worked for Phelps Dodge, moly is basically driven by byproducts from copper mines. And so it's hard to think if you could ever develop a primary moly mine. People tried, but then what they didn't realize is the people that have the byproduct, they can change their mine plan to mine moly-rich parts of the mine, just because moly went up more than when the copper, which is what we did at Phelps Dodge. So when copper tripled, I think moly went up almost 10 times. And so you would pick these moly-rich areas, and then suddenly there was more moly than you thought would, because the market doesn't have access to these big mines and their mine plans, and they are flexible. So I don't tend to do those because I know there's a high risk behind them that people don't really understand how the big mines will react to it.
So avoid cobalt, in your opinion, right now, or at least not actively looking for cobalt projects.
Yeah, I mean, if I had cobalt as a byproduct in a project, I'm happy, but I wouldn't go look out for primary cobalt, let's just say.
Okay.
Primary moly.
What about Mexican mining reforms? We talked about that last time you were on the show. Any updated thoughts?
No, and surprisingly, most companies aren't talking about it a lot. Usually it's buried in their MDA, and why it's buried is because even though it's a law, people don't know how it's going to be applied, because this was made as a law like here, and now it's got to come down to see, okay, who's going to test this? What most of the legal disputes are about is taking projects from operators that have been in Mexico and trying to grandfather them. Whereas the government's saying, hey, you can't grandfather these projects, whereas these guys are, the only people that are winning right now are the lawyers. That's the profession that's winning right now in terms of this. I don't think it's the Mexican government. I don't think it's obviously the companies. Definitely not the explorers. I'm involved in a Mexican mining conference in February next year, and most of that will be around, well, what the hell's going on? How does this apply to us? When can we start working? Because it's even perception risk is a problem, because you're not going to get money. Nobody's getting money right now, but let's say it was a little bit more of a buoyant market. Your first option may not be a Mexican explorer, right now. And most of the ones I've seen or I have exposure to are now diversifying outside of Mexico. They're going to Canada, they're going to Nevada, they're going somewhere else. And I doubt if there's any new companies right now that are thinking about getting their toes wet in Mexico right now.
Do you have any exposure to Bolivia as a jurisdiction in your portfolio?
No, never have.
And would you go there if you saw something, or is that one of the jurisdictions you write off?
No, it's too left wing of a government. So if you ever find something really, really good, I mean, they'll take it. And they would have no bones about doing it. And there's also a lot of, what do you call it? Artisanal miners, let's call them that are significant players. And so you definitely need a lot of experience dealing with a whole bunch of people in terms of how you mine something, or how you deal with workers, and who you compensate, and that sort of stuff. So yeah, I don't tend to expose myself to that country.
Joe, this next question has to do with what you do when you own a stock that's approached for a takeover, or there's an agreement made between the two companies and the stock jumps 30-40% on the announcement. Do you personally usually just sell when you get that liquidity and that bump, or do you hold on to it? And the reason I ask is because we can look at tech stock, and after the Glencore offer, it's back to where it was pre-offer. And so it would have been wiser to sell, in the last 7 months.
Well, I would say specifically with tech, which I bought because I was bullish. I continue to be bullish on coal because I think that that's an asset that's undercapitalized, and I don't see it going away as soon as other people think it's going to go away. And you still need metallurgical coal for steel. So the problem for tech was, one, most of their commodity prices have come down, as they have for everybody, but they've had a lot of operational issues. So their Q3 2023 results that just came out, 15 to 16% drop in revenue and a 36% drop in EBITDA. And that's partly because of commodities, but also operational issues, geotech issues at Highland Valley, equipment failures at Red Dog, which is zinc. And then they also, they had this project called New Range Copper Nickel with Polymet. And that one had a permit revoked by the U.S. Corps of Engineers in June. And that's a copper nickel project. So, I think tech has been taking a plunge more so because of their financials, rather than a resonating impact from the bid sort of diminishing in time. So I don't know if that's a great example, But if I did get an offer, I would probably sell at least half of it into it and keep it, because sometimes I sell into it and, because that was my sort of thinking, okay, sell it and I might own shares of the takeover company, which I don't want, and sell it. That's usually worked, but it did not work with respect to New Market. So New Market is the company I owned, which was a junior in Australia, and they were operating Fosterville. And I just got there when they were finding, the zones of high grade, which had the antimony, better milling, higher grade, because Fosterville was a refractory bio-oxidation project that, made money, but not a lot, very marginal. And then they started finding these new zones. And when they started finding these new zones, then they put in a gravity circuit, the recoveries were better, and then it just went nuts. But it didn't go nuts in New Market. It went nuts in, Kirkland. So if I kept the shares in Kirkland, I would have done much better. But I sold it because I thought, well, that's what I wanted. I made a double. Boom, I'm gone. Let these guys deal with it. But what they dealt with was a much better asset as they were drilling and they found more. So yeah, it can be good sometimes and it could be bad sometimes. But, if you want to try to mitigate that, then maybe you just sell half into that bid.
My last question, Joe, before you go, is in the gold and silver sector, mining sector, from the perspective of the issuer, not from the perspective of the investment bank, what's the most impressive financing that you've seen recently?
Okay, and a project I visited, I don't own, but I would say Reunion Gold, because we don't have the backdrop of flow-through financing helping or anything like that. This is in Guyana. They have the Oko West open pit amenable project that they put out a resource in June, about 4.2 million ounces of just under 2 grams. 60% of that was indicated. And Guyana is one of the better jurisdictions in Northern South America. They raised $70 million, and I believe they upsized it, but it was 46 cents per share. They've got lots of shares out. But it was a 20% discount to their 52-week high, which at that time just happened, I think, the month before. 60% premium to their 52-week low, but importantly, a 6% discount to their 20-day volume weighted average. And so if you want to look at it, look at the 20-day volume weighted average, and if you can get it almost at the money there in this environment, no warrants, I think that was a success. And then it was a significant amount of capital in terms of $70 million.
Excellent. Well, Joe's website is ExploreCoinsights.com. You can go there, find more about his subscription service, as well as free articles and educational resources there. As always, Joe, really appreciate your insight. Thanks for coming on today's show.
Great. Thanks a lot, Bill.